I'm Rajesh, and today we are diving into the basics of accounting. Accounting is a systematic process of recording, summarizing, analyzing, and reporting financial transactions and information about a business or organization. It provides a way to measure the financial performance and health of an entity. Here are some basics of accounting. 1. Double entry accounting. Double entry accounting is the fundamental concept in accounting. It means that every financial transaction has equal and opposite effects on at least two accounts. In other words, for every debit entry, there must be a corresponding credit entry. This system helps maintain the accounting equation, which states that assets is equal to liabilities plus equity. 2. Accounts. Accounts represent categories used to classify and track financial transactions. Common accounts include assets, example, cash, inventory. Liabilities. Example, loans, accounts payable, equity. Example, owner's equity, retained earnings. Revenue. Example, sales, fees. And expenses. Example, salaries, rent. 3. Financial statements. Financial statements are the primary output of the accounting process. The three main financial statements are: balance sheet. It provides a snapshot of a company's financial position at a specific point in time, showing assets, liabilities, and equity. Income statement. Profit and loss statement. It summarizes a company's revenues, expenses, gains, and losses over a specific period, resulting in net income or net loss. Cash flow statement. It tracks the flow of cash in and out of the business, categorizing it into operating, investing, and financing activities. 4. Recording transactions. Transactions are recorded using journal entries. Each journal entry includes the date, accounts affected, a description of the transaction, and the dollar amount. Transactions are then posted to the general ledger. 5. General ledger. The general ledger is a complete record of all financial transactions of a company. It consists of individual accounts that are updated with each journal entry. 6. Trial balance. A trial balance is a list of all the accounts in the general ledger and their balances at a specific point in time. The total debits should equal the total credits, which helps ensure the accuracy of the accounting records. 7. Adjusting entries. Adjusting entries are made at the end of an accounting period to ensure that all revenues and expenses are recorded in the correct period. This includes accruals and deferrals. 8. Closing entries. Closing entries are made at the end of an accounting period to close temporary accounts, revenue and expense accounts, and transfer their balances to the retained earnings account. 9. Financial analysis. Financial analysis involves using financial ratios and metrics to assess a company's financial health and performance. Common ratios include the debt-to-equity ratio, return on investment, ROI, and profit margin. 10. Auditing and compliance. Auditing is the process of examining and verifying financial records to ensure accuracy and compliance with accounting standards and regulations. Audits can be conducted internally or by external auditors. These are some of the fundamental principles and concepts in accounting. Accounting is crucial for businesses to make informed financial decisions, comply with taxation and reporting requirements, and communicate their financial performance to stakeholders. If you are like our classes, please do subscribe to our channel.